Ever wondered if the stock market game is rigged? You place a trade, thinking you've got a great price, only to see it move against you in a split second. It feels like someone, somewhere, knows your every move before you even make it. Well, you're not wrong. Welcome to the hidden world of dark pools, the secret trading venues where institutional giants operate in the shadows. This isn't just about stocks. It's about how the very architecture of modern finance can be used to front-run your future. Imagine a parallel financial universe, invisible to the public eye. No flashing tickers, no screaming traders on a chaotic floor. Just silent, massive blocks of shares, changing hands in complete anonymity. These are dark pools private exchanges, hidden from the public markets, like the New York Stock Exchange or NASDAQ. They were created with a seemingly noble purpose, to allow large institutions like pension funds and mutual funds to trade huge volumes without causing massive price swings. If a pension fund tried to sell 10 million shares of a company on the open market all at once, the price would plummet, hurting the very retirees they're supposed to protect. Dark pools were the solution. Trade big, trade quiet. But where there's secrecy, there's opportunity for exploitation. And this is where the story takes a dark turn. The biggest players in this shadow market aren't just the quiet pension funds. They are high-frequency trading firms, or HFTs, the apex predators of the financial ecosystem. These firms use supercomputers and complex algorithms to execute trades in microseconds, a speed unimaginable to a human. They thrive on information, and dark pools have become their favorite hunting ground. Here's how the hunt works. Let's say your mutual fund, which holds a piece of your retirement savings, decides to buy a large number of shares in a promising tech company. To avoid spooking the market, your funds manager sends the order into a dark pool. But the HFT firms are already there, lurking. They use sophisticated techniques, sometimes called pinging, where they send out tiny, rapid-fire orders for various stocks to detect large institutional orders hiding in the pool. Once they detect your mutual fund's intention to buy, the game begins. The HFT firm's algorithm instantly races ahead to the public exchanges and buys up all the available shares of that same tech company, driving the price up by a few cents. Then, when your mutual fund's order finally executes, who do you think they're buying from? The high-frequency trader, who is now selling them the same shares at that slightly inflated price. It's a practice known as front-running. It happens in the blink of an eye, 1,000 times a second. You might think it's just a few pennies per share. What's the big deal? But multiply those pennies by millions of shares and then by thousands of trades per day. The profits are astronomical. We're talking about a multi-billion-dollar wealth transfer, siphoned directly from the pockets of everyday investors, from your retirement account, your 401k, your children's college fund. It's a microscopic tax on nearly every institutional trade, a silent drain that compounds over years, eroding the value of your long-term investments. The most insidious part: it's often perfectly legal. The lines are blurry, shrouded in complex regulations that are difficult to enforce. These HFT firms aren't breaking into a bank. They're exploiting the very plumbing of the financial system, a system that has become so complex and fragmented that only those with the fastest computers and the smartest programmers can truly understand and master it. The very existence of dozens of dark pools and private exchanges creates what's known as a fragmented market. Your order doesn't just go to one place. It gets sliced and diced, routed through a maze of different venues. This complexity is a feature, not a bug, for those who know how to navigate it. It allows them to see the order flow, to piece together the puzzle of who is buying what, and to position themselves to profit from that knowledge. You're playing checkers, while they're playing three-dimensional chess on 1,000 boards at once. This isn't a victimless process. The liquidity that high-frequency traders claim to provide often feels more like a predatory fog. They can appear and disappear in a millisecond. During times of market stress, like the flash crash of 2010, this algorithmic liquidity can vanish entirely, causing markets to collapse violently before regulators even know what happened. The stability they promise is an illusion, a fair-weather friendship that disappears when you need it most. So, what does this mean for you, the individual investor? It means the playing field is not level. The narrative that the stock market is a democratic place where anyone can build wealth is a dangerous oversimplification. In reality, it's a tiered system. There's the retail level, where we operate, Then there's the institutional level, and above that, in the shadows, is the ultra-high-speed algorithmic level, a domain dominated by a handful of elite firms. They have access to better information, faster technology, and preferential treatment from the exchanges themselves. Some exchanges even allow these firms to co-locate their servers right next to the exchange's matching engine, cutting down their travel time for data to literal nanoseconds. You're fighting a battle with a dial-up modem against an opponent with a fiber optic cable plugged directly into the source. The solution isn't to abandon the market. That's what they would want. Pulling your money out in fear means you miss out on the long-term growth that is still the most powerful wealth-building tool in history. The real solution lies in awareness and reform. Understanding that this ecosystem exists is the first step. It's about demanding greater transparency and fairer market structures. Regulators are in a constant cat-and-mouse game with these firms, always a step behind the latest technological innovation. We need to question the very structure of our markets. Why do we allow this level of fragmentation? Why is it legal for some participants to pay for faster access and better information? Shouldn't the goal be a single, transparent, and fair marketplace for all? These are the questions we must ask our brokers, our fund managers, and our elected officials. The dark pool drain is a silent, ongoing heist of epic proportions. It's not a single event, but a continuous systemic process that disadvantages the many for the benefit of a select few. They are trading in the shadows, using your own future investment plans to front-run you and capture profits that rightfully belong to you. The next time your portfolio underperforms slightly or a trade doesn't go your way, remember the invisible world of dark pools. Remember the silent drain. Knowledge is your first line of defense. Stay informed, stay vigilant, and demand a fairer system. Thanks for joining us in this deep dive into the shadows of the financial world. If you found this illuminating, be sure to like, subscribe, and hit the notification bell so you don't miss our next investigation. See you next time.